Have you ever noticed your savings rate change? Or a car loan suddenly get more expensive? Or mortgage rates jump, even though nothing around you seems different? That is not random. And it is not just your bank. Behind the scenes, one institution quietly shapes how fast or slow the entire economy moves. That institution is the Federal Reserve, usually called the Fed. The Fed does not decide how much you earn. It does not set prices at the store. And it does not control individual businesses. What it controls is the environment, the financial conditions that influence millions of decisions at once. By adjusting those conditions, the Fed tries to keep the economy stable. Not too hot, not too cold. In this video, we will explain this system simply. We will look at what the Fed is trying to achieve, the main lever it uses, how that lever actually works, and how the effects eventually reach you. At its core, the Federal Reserve has one job: guide the economy toward balance. Congress gave the Fed two clear goals. Together, they are called the dual mandate. The first goal is price stability. This means keeping inflation low and predictable. The Fed aims for prices to rise slowly, about 2% per year. When prices rise too fast, paychecks lose power. Groceries feel more expensive. Rent stretches household budgets. The second goal is maximum employment. This does not mean zero unemployment. It means a healthy job market, where most people who want a job can find one. The Fed is always balancing these two goals: stable prices, strong employment. To reach those goals, the Fed mainly uses one tool: interest rates. Interest rates are the price of borrowing money. When borrowing is cheap, people spend more. Businesses invest more. Hiring usually increases. When borrowing is expensive, spending slows. Businesses delay expansion. Hiring cools down. By raising or lowering interest rates, the Fed nudges the economy faster or slower. But the Fed does not set your loan rate directly. It works through banks. Think of the Fed as a bank for banks. Commercial banks keep money there, called reserves. The Fed pays interest on those reserves. This rate matters a lot, because banks will not lend money for less than they can earn, risk-free, at the Fed. So when the Fed raises the interest it pays banks, all other rates rise with it. This creates a floor, a base level for interest rates across the economy. Once that floor moves, the effects spread outward. This process is called transmission. First, very short-term rates change. The rates banks charge each other. Then longer-term rates begin to move. Car loans, business loans, mortgages. These changes do not happen overnight. They ripple slowly. A lower mortgage rate might help a family buy a home. That creates demand for construction, furniture, services. A cheaper business loan might lead to a new factory or more hiring. Small changes at the center can shape the whole system. Sometimes the economy runs too fast. People spend quickly. Demand rises faster than supply. Too many dollars chase too few goods. Prices begin to surge. This is when inflation becomes a problem. To cool things down, the Fed raises interest rates. Borrowing becomes more expensive. Saving becomes more attractive. Spending slows. Price pressure eases. But this balance is delicate. If rates rise too much, the economy can stall. Jobs can be lost. The Fed is constantly adjusting, trying not to overcorrect. Sometimes interest rates are not enough. During major crises, the Fed may cut rates to near zero. But the economy can still struggle. When that happens, the Fed uses emergency tools. The most well-known is quantitative easing. The Fed creates new digital money and uses it to buy large amounts of financial assets, mostly government bonds. This adds cash to the system and pushes long-term interest rates lower. The goal is to restore confidence and prevent financial collapse. These tools are used rarely, only in extreme situations. When you step back, the system becomes clear. The Fed watches the economy, sets its targets, adjusts interest rates through banks. Those changes spread slowly through loans, spending, hiring. Nothing moves instantly. It is like steering a massive ship. Turns take time. The Federal Reserve does not control your choices, but it shapes the conditions around them. By managing inflation and employment, it tries to create stability. That invisible system influences everyday life. From saving money, to buying a home, to finding a job. This is Simplexplain, complex ideas simply explained.